Welcome to Get Rich Education. I'm your host, Keith Weinhold. How do you get the money for real estate? Whether it's your first property or your 21st property, you don't have to trade your time for money at a job to save up for a down payment for every property that you buy. In fact, you probably shouldn't. It's a mind spring of ideas on where you can find that real estate capital with Ken McElroy and I today on Get Rich Education. You know, starting in real estate seems hard for some. Even experienced investors can find it difficult to achieve the success that they had hoped for. What if there was one small change everyone could make that would solve these challenges? Allie Boone offers a book that really no one else has. It's an easy-to-understand glimpse into the real estate investing industry and your mindset. It's life lessons on hacking your mind before you hack your wallet. Her book to grab on Amazon is called Not Your How-To Guide to Real Estate Investing. Most rental property investors choose either cash flow or home price appreciation, but one real estate market can give you both. Jacksonville, Florida, with 27% lower home prices than the national median, 1% higher gross rents, and Jacksonville has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and appreciation for tomorrow. To invest for cash flow and growth in Jacksonville, go to cashflowandgrowth.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Cambridge, England to Cambridge, Massachusetts, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. When it comes to how you find money for real estate, I think the most natural and the first thing to think of is that you're going to trade your time for dollars at a job, and then when you've saved up, you've come up with a down payment, usually between 3% and 20% of the purchase price. You do that with your own money. And I'll tell you, that's probably how most people do it. And that's how I bought my first property, all with my own money and that down payment that I earned from a day job at an engineering company. Yes, it was that 3.5% down for that seminal fourplex. But I didn't do that again. I had learned that it's better to use other people's money for my deal. So what I did is I took equity that I had accumulated in that first fourplex after owning it for 3 years, which was a blue fourplex. I pulled it out and then I used it as a down payment on a second fourplex rather than using my own money. Well, that second fourplex, and it was a bigger one, a green-colored building where everyone had their own one-car garage. I remember I was pretty proud of that building. But in any case, this way you can think of it as that market appreciation made the payment on that second fourplex for me. I was leveraged. So if you understand that, you'll understand that in a circuitous or perhaps unintentional way, the bank actually made much of my down payment for me from leverage in that first fourplex into that second fourplex. Well, let's talk about some other ways that you can get your seed money to invest in real estate. It's not just your down payment that you typically need to make to begin owning real estate. It is those loan closing costs and prepaids that often total about 4% of the purchase price that you need to make on top of your down payment. Well, a way to start using other people's money on your very first deal is to offer the seller a strong price for their property, but you ask the seller to pay some or all of your closing costs for you. So say they paid $3,000 of your closing costs for you, and then you, in turn, offer them $3,000 more for the property than you would have otherwise. Well, that's a wash for the seller, but for you, that's $3,000 less that you have to pay at the closing table at the time you buy, and now you get to finance that $3,000 for 30 years. Well, that's a great deal for you. So to help you answer the question, how do you come up with the money? Then don't forget that the seller can help you. Be mindful, though, that there are some limits typically as to how much of your closing costs your seller can help you with. It's usually 2 to 3% of the total purchase price that is set as the maximum. Now, when it comes to the property seller, you can perhaps obtain something called seller financing. Seller financing, it confuses some people, but it really just means how it sounds. You get a loan for the property from your seller, and then over time you make payments to your seller. That's right, I didn't say anything about a bank there because there's no bank involved at all with seller financing. So it's an agreement between you and the seller, and you make the payments to them over time. So then both buyer and seller sign a promissory note, and that should outline the interest rate, the repayment schedule, and the default consequences. Now, you might be able to get in with a smaller down payment with seller financing, but few sellers that agree to do seller financing are going to give you a loan as long as 30 years. I mean, really, what normal person would give a 30-year loan anyway? I mean, would you give any kind of loan to a 34-year-old friend and trust that he'll make every single monthly payment until he's age 64? No way. At any interest rate, that might be kind of nuts. Well, largely, 30-year loans exist because they are government-backed. So to get back to seller financing, your seller is likely going to want to be paid back in less than 30 years. Seller financing isn't common because a lot of people just don't know about it, and they just sort of assume that a bank needs to be involved every time. Another reason that you haven't heard about it is that a lot of sellers, they need the full sale proceeds in a lump sum all at once in order to buy their next home. So a lot of sellers don't want to offer it at all, and most sellers haven't even heard of seller financing either. But for sellers that do know about it and they do want to do it, they should put seller financing in the listing. It makes their listing stand out. Sometimes you'll see a listing with that in it. And also with seller financing, one advantage is that you and your seller can often close faster. For buyers, seller financing lowers your closing costs. Now, if there's ever a property that you want to buy and you don't have the money and you need some flexibility, you might ask the seller if they can offer this for you. And it would behoove you to educate the seller on how seller financing could help them, because oftentimes this means that the seller can report the transaction as an installment sale if you make them payments over time. And see, therefore, the seller gets some preferential tax treatment rather than just that one lump sum that they would get if they sold it more conventionally through a bank. So if you can educate the seller on that, now you're starting to win. And it's not only about what you want, it's about helping the other side get what they want and point that out to your seller. But one word of warning with seller financing is that you do want to make sure that the seller owns the property outright and that they don't have any outstanding mortgages on the property. Well, that is seller financing. It might help make a deal happen for you because you might be able to make a smaller down payment and have lower closing costs than what a bank can offer you. Another way that you can get money for your property is to take a loan from the equity in your existing property. And just because you can do that doesn't always mean that you should do that. Often you can borrow against your primary residence up to an 80% loan to value ratio. If you get, say, a second loan on your home at a 4% interest rate against that equity in your property, well, that's going to generate a new monthly payment that you now have to make. So your job, and therefore your risk, is that you need to take that borrowed money, go out into the market, and generate a return that meets or exceeds your payment on that 4%. And once you do, now you're dollars ahead. Now, when you take a loan against your home this way, often with something like a HELOC, a home equity line of credit, you now have the ability to basically write yourself a check for, say, $50K or $250K, and understand that that is a non-taxable event. And not only is this loan a non-taxable event, but in some cases, depending on how you spend the money, the interest paid is even tax deductible to you. Check that with your CPA because there are a number of instances where it's not tax deductible. Now, once you buy and control a property, a way to have others make your payment for you is with what we call house hacking. That effectively means bringing on roommates. You might remember that a few weeks ago, GRE listener Ryan Shaw of California did this beautifully by renting out rooms to college students. Now, a lot of times, if you're buying a duplex, triplex, or fourplex, and you think that you don't make enough income to qualify for it because it's just a larger purchase price overall, well, what you can do before you even own the property is you can take 75% of the existing tenant's income a lot of times. So yes, the tenants that already live in that building before you even buy it, and you can use that income toward your income to qualify. And gosh, I really love that particular premise conceptually, because think about it, you're actually using other people's money before you even own that property when you get to use 75% of those existing residents' income in order to qualify for it in the first place. Now, another way to get the money for real estate is something called a lease purchase agreement. The term lease purchase is usually seen as a hyphenated phrase. I've seen some people call this a rent to own property. 3 hyphenated words together there. So lease purchase and rent to own, they sort of mean the same thing. And I am only trying to be grammatically prim and proper here because if you can visualize a word or phrase, it helps you retain it. So what a lease purchase agreement is often something that you can use for a primary residence that you really want, but you can't afford the down payment. So what you basically do is you sign a pretty standard lease. So you would be a renter yourself. That's the lease part of the lease purchase. But the purchase part, that means along with signing the lease as a renter yourself, you also sign an agreement that gives you an option to purchase the property later. So that's the lease purchase, always hyphenated. So the landlord retains the title to the property. And how this works is that you're usually going to pay the landlord above market rent while you're renting from them. And then that extra amount above the market rent, that gets applied to the principal if you decide to exercise your option to buy the property later on. So at the beginning of the lease period, you do negotiate a sale price up front typically, and you put down something called an option fee. And this option fee compensates the landlord if you decide to back out of the deal and not buy the property. So this gives you some flexibility. If you decide to buy the property down the road, then your above market rent paid effectively becomes equity that you get to have in the property. But if you don't buy the property, you lose both your option fee and that equity that would have been put into the property. That is a lease purchase agreement, also known as a rent to own property. And I'll tell you that that particular arrangement is not common. You just don't often see this in real estate. On the subject of not common, but certainly possible, one way to get into a property with absolutely nothing down is to assume a seller's mortgage. You just take possession of the property and start making payments for the seller to the lender. But one reason that mainstream mortgage companies do not allow this, assuming this seller's mortgage like this, is, of course, that bank loan terms are tied to the credit worthiness of a borrower. They just can't let anyone come in and take that over. Another way to get money for a property, although it's also not common, is to negotiate a seller-held second mortgage. This would sort of be a hybrid to seller financing. This means that to get into the property, what you would do is borrow, say, 80% from the bank, and you would borrow another 10 or 20% from the seller, meaning that you would now only need to come up with 0 to 10% yourself, depending on what you've negotiated there. So again, that is called a seller-held second mortgage. But yeah, we're really getting into some methods that are not common or just aren't allowed by mainstream banks. Yet in some instances, it might help to ask a seller if it is available to you. If you can't remember those names or techniques and you want to read more about all these later, I will list each of these techniques that I talked about in the show notes for you. And if you don't know how to see that, since this is episode 335, you can simply go to getricheducation.com/335. And there they are. Ken McElroy joins me in a few minutes here when we talk about getting the money. He's going to talk to us about how you get money from other investors, since he's such a master of that. We'll discuss borrowing from your retirement funds for investing in real estate and the pros and cons of that and more. I think you know that from listening to me over the years, my favorite way to get money for real estate deals is not having partners, and it certainly isn't trading my time for dollars to get the down payments. It's using leverage to my advantage. Love the leverage. Love it so much. it makes something that sounds heretical until you understand it. And that is that compound interest is lame. Leverage is what makes you wealthy. Since the return from home equity is always zero, take it out of one property, move it into another, reset your leverage ratio, and watch your wealth grow rapidly over the long term. Just copy me if you want to. Do what I do. Now, for turnkey property, those providers likely aren't going to do seller financing or certainly not a lease purchase agreement. Those aren't the businesses that they're in. But I'll tell you what, if you take debt equity from your home or another property and convert that into a down payment, that works for them all day. So do what I do. I do my own property buying at greturnkey.com. So get qualified for a mortgage with a company that specializes in income property loans like a Ridge Lending Group or whomever you prefer there, and then buy through GRE Turnkey. What's happening with the providers there now is that the Florida providers have a number of new construction single-family homes, up to 4plexes available. In Alabama, they are working to get more inventory online as they're seeing a lot of demand in the Huntsville, Alabama market. Mid-South homebuyers, they operate in both Memphis and Little Rock. They keep turning out the inventory, and that specifically is a great resource for beginners there in those two markets with Mid-South homebuyers. Also, there are new construction single-family rentals in Texas and elsewhere. Yeah, you can just do what I do and buy where I buy at greturnkey.com. Ken McElroy and I, next. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your EQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an EQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text EQRP in all capital letters to 72,000. The people that our listeners can't stop talking about are Ridge Lending Group and MLS 42056. They provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to 4plexes. They're the number one lender for both beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com.
Hi, this is Rich Dad Advisor Garrett Sutton. You're listening to the always valuable Get Rich Education with Keith Weinhold. Don't quit your daydream.
You're already familiar with today's guest, I think, because he is one of the most recurrent guests that we've ever had here at Get Rich Education. He's the Rich Dad Advisor for real estate. He's written a lot of influential books like the ABCs of Real Estate Investing and others, all of which I've read. And you know something about him? He's just really approachable, even though he's been doing this for a long time and he does a lot of really high dollar deals. He's just really someone that you can relate to. He really deals very much in the multifamily investing space, big apartment buildings. He runs MC companies. They're a real estate syndicator. What a syndicator really does is they go out and identify a bigger apartment deal than you could ever afford yourself, and you can participate with MC companies in one share of that. He is based in Scottsdale, Arizona. He really does a lot with community and giving. He's a really giving guy. So it's great to have back on Get Rich Education, Ken McElroy.
Hey, thanks, Keith. Great to see you as always.
Hey, it's so good to have you here, Ken, because when it comes to real estate investing, people come up, they read your books, they get interested in real estate investing, but it's quite common for a person to feel intimidated. Some of the prices for real estate seem unapproachable to a beginner, and you don't always just have to come up with a down payment in your own money. There's so many other ways to find investment money. So a beginner really has more options for investment money. Oftentimes, they're thinking about funds that they would have to go out and work for and trade their time for dollars for and save up for. And that's certainly one way to do it. But I think oftentimes you as a beginning investor or even an intermediate investor, you have more funds to work with right now than you even realize.
Yeah. And I would go even further, Keith, to say that I actually don't know any real estate investor that started with money.
I didn't. Yeah, I started out with that 3.5% down payment on a fourplex. I just scraped it together.
But I understand the question. I understand the mental hurdle. I do. My parents, they scrapped it together. They saved whatever they could, and they bought the house that I grew up in. And that was the house that we never moved out of, actually. My mom still has it from the time I was a young boy. And that's the way most people think of real estate. And we're talking about is something very different. The key to real estate is finding the deal that works, because it's been my experience. Like if I called you up, Keith, and I said, hey, I found an incredible duplex and you're going to make 10% on your money, you would I'll go, okay, I'll take a look at that.
Right.
And so that's what people don't understand. It's the education is in the deal that you see, and then the money follows. And there's a lot of ways to get money. I know that's what we're going to talk about, but it's the deal itself generates the interest. Just like you guys. I mean, we've all lent people money before, sometimes you lend it, you're like, okay, I'll never see that again. And sometimes you just know the person's going to pay you back. Well, it's the same with real estate, in my opinion, is some deals are great and some deals are not great. And so what does the person that's bringing the deal see? Is it a good deal or not a good deal? I think there's a tremendous amount of money chasing stuff that makes a return for them.
100%. And one doesn't just need to come up again with that down payment, their own money. I was able to put it together because I could get an FHA loan. A lot of people are thinking about that 20% down payment. But yeah, when you've been around the game a long time, like you have a network. If you identify a 275 unit apartment building, people are thinking, well, Ken's got the network. He's been in the game for a while. He's got a great reputation. He's going to find the money for it. What would you tell a beginner that just can't seem to get over that hurdle of, say, just getting a 20% down payment together for a $150,000 rental single family home?
I'll tell you what I first did. I had a rich uncle. Like we all have rich uncles, right? He's in his 90s now. He's still alive. He lives in Lincoln, Nebraska. But I'll never forget. I was like, okay, I'm going to get into this real estate game. This is just after college. And so I brought him a deal. And he's very sophisticated. And that was one of the best. He, of course, said no, because he saw what I didn't see. It was a small little property. He educated me as I was pitching him that deal and showed me what I didn't see. And so the next deal I went out, I looked and I saw something a little bit better. And I think what happens is you build your network. For me, I started with friends and family. Who do I know with money? And at that time, there's maybe 2 people. So then from there, if you have something that can make people money, when you start asking questions, you'll be surprised at how many people are looking, how many people are sitting on a lot of savings, how many people are afraid of the stock market, how many people have a lot of cash flow coming out. I was with a friend of mine yesterday at dinner. This is a friend of mine I've had for years, and his company's killing it. I've never even asked him to be in any of my deals. He's like, hey, why don't you ever ask me to be in any of your deals? I'm like, well, I go, I don't know. He's like, well, I want to be in your next deal. And I'm like, okay. What happens is you start to get into these circles. And by the way, 10 years ago, his company wasn't doing well, and I actually lent him some money. So it's just one of those things where you just immerse yourself in it, and then you start to put the deal out, and people educate you on what they see or what they don't see.
Okay, so say that someone finds an 8-unit apartment building that seems to be a good deal. You're talking about pooling other people's resources together in order to secure, call it the down payment for that deal, just the equity portion of that deal. Is there a difference between a partner and an investor? Can you speak to us from that perspective? Because, of course, the SEC, the Securities and Exchange Commission, have certain rules around who's a partner, who's an investor. When are you really aggregating things in a syndication? When are you just partnering with a friend? Can you tell us about that when it comes to other people's money for the down payment?
I will. That's a great question. So let's say we're looking at an 8-unit deal. What's going to get an investor interested? And what's going to get the lender interested? And what's going to get a partner interested? So the first thing the lender is going to look at are the numbers, period. And they're going to look at you as a borrower, sure. But they're going to look at the number, because what's going to pay them back? That property. They're going to have that property as collateral. So they're going to decide how much they're going to lend against that property based on how the cash flow is. So if you find that 8-unit building, and let's say you have tenants that have been in there 10 years, and they're $150 or $200 above market, that's going to make the investor excited, because you're going to say, hey, when these people renew, there's an opportunity to raise up to market, not above market. And therefore, it's going to increase the value and the cash flow. Or maybe there's some stuff inside of the operations where they've been spending too much money on certain things and you can save on the expense side. So that's what excites investors. They're looking at it from two very different things. When we put a deal in front of an investor, we don't just put a deal in there that's going to be the same, or maybe it's going to increase because the market goes up a little bit. We're trying to force equity. So when I'm making money for the money, that's when investors get excited. On the partner side of it, that's entirely different. That's like somebody that has a partnership that's actually as the developer, maybe they're doing stuff together. That's even more complicated. It's actually the hardest of the three because sometimes you have partners that don't do anything, or maybe you're not aligned on just so many levels. I mean, we could do a whole show on this issue, but the investors in a lot of ways are much, much easier. The lenders, they look at the numbers and the facts. The investors look at the numbers and the facts, especially if there's an opportunity for, if you're going to make them money on their money, they're going to be very interested. So they're three very, very different people.
Oh, you bring up some great points. Yeah, they say the most difficult ship to sail is a partnership. I really don't invest that way myself, but I like that you brought up the point that, okay, if you're an investor that doesn't have money or doesn't have much money and you want to bring people alongside you to invest in your deal, the thing that excites them is seeing meat on the bone in a deal, like buying that 8-unit property where we know that we can raise rents when we get new tenants in there because the existing ones are paying $150 to $200 per month under the market. On an apartment building that I bought, I spent about $20,000 on a new, more efficient heating system. Well, that lowered my natural gas bill by $400, therefore increasing my cash flow by $400. That really made a lot of sense in adding value to the building. So this is a great point in what would get someone interested in your deal. It's showing them where you're going to add the value and how you're going to do it.
Right. So one of the strategies that we did back in, say 8, 9, 10, when we started buying properties after they crashed a bit, is I said one of the strategies then was, okay, I want you to go out and find every single property that's over 200 units that has washer and dryer hookups, but no washers and dryers. That was our strategy. And we went to Texas and we found thousands of those, thousands. We bought, I don't know how many, maybe 8 or 9 or 10,000 of those. Think about how simple this is. The washer and dryer set is $600 for the unit. We give it to the tenant. Doesn't matter if they're in their rent, in the middle of the rental or not. They're happy because they don't have to go down and get coins and go down to the laundromat or the prepaid card or whatever it is. So now they're in their unit. They have this brand new washer and dryer. It cost me $600. When their lease renews, I say, listen, now you know we're saving you a ton of money on the laundry. And so we think that's worth $50 to $75 a month. They agree because really for them, there's no additional expense. I mean, there's no additional revenue. They're just saving from having to spend it and walk down and sit down with the load while it's going. So that was a strategy that we did for years. That $50 a month, let's say, pays for itself in 1 year, 50 times 12. So we paid for the washers and dryers in 1 year. And then after that, we had every single unit at $50 more a month. That's what investors get excited about. When you start outlining strategies like that, and you could do it with flooring, you could do it with renovations, you could do it with putting in backyards for pets, you could do it all kinds of ways. And so when you start to build your rent roll and you show income that can and value that you can increase for the investor, then all of a sudden the investor gets excited.
That's a great example with what you did with the washers and dryers in Texas. Not only did you increase the income from the property, as we know, apartment buildings are based on the NOI, the net operating income of the property, so therefore you increase the value at the same time. I think it's so interesting that you found that narrow niche. This is exploiting an opportunity. What has washer and dryer hookups but no washer and dryer? But it's not exploiting people. In the end, you're actually making your tenant's life better. You're thinking about how you can improve the lives of others first and then creating value from that, making it easier for them to do their laundry.
Right. And at the end of the day, I mean, if you take a look at for 100 units times $50 a month times 12 or 200 units, you've now increased that net operating income a lot. And all of a sudden, you've created, in some cases, $2, $3, $4 million in value to the property just by buying those washers and dryers. So for $100,000 to $150,000 investment, you're making a $3 or $4 million value add.
That's the type of thing that interests and attracts investors. We talk about how to find investment money. I think one place, Ken, that people are scared to look is using the equity from their primary residence, doing a cash out refinance, and then redeploying that money into an income property. Now, just because one has the ability to do that, that does not mean that they should always do that. But if that scares someone, I think the way to think about that is you're not losing any equity. What you're doing is you're just making an equity transfer from your home into a second property. But you want to talk about some more strategies for using home equity for someone's first rental property investment and when they should and shouldn't do it?
A couple things. One, when you do that, it's tax-free. So you're actually scooping your own equity. So it's not taxed because it's debt. I think that's important.
Great point.
The second thing is you actually do pay for that. So you have to calculate the payment on that additional equity. But in a lot of cases, as we're starting to see now, is we've had a massive refinance year. Some people were sitting in even I was sitting at a 4.5% interest rate way back in the day on a loan on a second home that I had. And, I refinanced it at below 3%. I didn't do a cash out, but I could have. I could have done a cash out and actually kept my payment the same. And so the point is that it's not always bad. What I always tell people to do is be careful. You don't want to leverage up that too high. And you don't want to get into a situation where if the property over here that you put the money in isn't doing well, and now you're having a tough time paying your primary residence, you got to be very, very careful in that regard, I say. But typically, I like to tell people to do that. If they have it in other investment properties, they have a lot of equity, then those are really, really, that's good low-hanging fruit to be able to just scoop that kind of equity and continue that momentum. It's a great way to harvest your own money and not have to go after new investors.
So I think the risk when you do a cash out refinance from, say, your primary residence in order to get a seed to place as a down payment in a new property, you touched on it. Yes, you do need the cash flow from that investment property to service the debt from that home equity line of credit or second mortgage or whatever you're doing, or then you might find yourself underwater. A lot of people, especially from the rich dad school, Ken, Robert Kiyosaki likes to say your home is a liability, not an asset, because an asset pays you, but the primary residence is a liability because it takes money out of your pocket every month rather than put money into it. I think one can make the case, though, that your primary residence is less of a liability if you intelligently harvest the equity and reset your leverage ratio, and think about it that way.
You're exactly right. I think what Robert was trying to say, and I agree with, if you look at the balance sheet, it's actually the bank's asset. The bank's giving you the money, so it's actually their asset. And I think that's what he was trying to say around that. But you're right. If you've got, good savings, you've got, let's say, a good income. And today, Keith, we don't always know what's that going to look like moving forward, as a lot of these jobs are being moved over to AI as an example. And we're starting to see things that are declining. So you got to be careful on that side. If you're reliant on your salary or your W-2 job, your paycheck to pay that primary residence, I always tell people to be careful. Make sure you have lots of reserves if you're going to do this.
Of course, your home, your primary residence is the bank's asset because you've created and you're giving an income stream to the bank. That's why it's an asset to them. Ken, when it comes to finding investment money, maybe from some of those non-traditional places, are there anything else you would like to cover for investors, whether that is borrowing from retirement funds or house hacking or seller financing or any other strategies when it comes to getting the money?
I think all those are great. Keith, at the end of the day, this is just about using other people's money. So the BRRRR technique is a great technique, house hacking, the seller financing. One of the things that I found, I was talking to somebody the other day, they had no idea. We have this big 401k issue where we have a lot of people sitting on these big 401ks. If they just move the money over to a self-directed IRA, as an example, they can actually control how that money's being invested. We actually have a lot of people doing that in our deals. In other words, they're sitting on all this 401k money, And so they are moving it from say a financial advisor or a wealth advisor into a self-directed IRA. And that became a vehicle for them. They didn't have any clue that they could even do that. So some of it is just educating other people. If they're sitting on savings, for example, educating them about the pending inflation, or if they're sitting on a big 401k account, educating them that how's their returns? Did they know that they could invest it on their own through a self-directed plan? Some of it's just jumping in and finding solutions for other people, because a lot of people are, even my parents, you kind of get caught in I have a lot of friends that are professional athletes and all their money is in savings, and for lots of reasons. And we can get into all the reasons behind that, mostly around trust. But the truth is they're comfortable with it in savings. So if you can sit down and just say, listen, I understand this is where you are, but this is the forces that are happening right now. So you just need to understand where everything's heading. So it's just educating people with money. And even if they don't invest with you, if you're just helping them understand the bigger picture and helping them, see something that maybe they didn't see. I found that that's a great way to raise capital, is to teach some financial education that maybe you read in a book, maybe you saw in a YouTube video, maybe you heard in a podcast, and help everybody have what they've worked so hard to earn.
You mentioned the self-directed IRA, or one might use that with an EQRP vehicle, like we talk about with Damian Lupo here, but a lot of people just don't understand that those options are available to them. People are getting increasingly concerned about the stock market valuations being high on a PE ratio, so maybe they want to take some of those 401k-based funds and put them into an EQRP sort of thing so that they can invest in real estate, in real assets. You mentioned the 401k. Some people don't realize, and again, this doesn't always mean that they should do it. It's just something to look at the pros and cons of, is simply borrowing from your 401k, borrowing from your retirement plan. When you're borrowing from yourself, you pay interest back to yourself. The risk there is you need to repay the loan on time, or you could be subject to a 10% penalty. But borrowing against your plan is another way to go for finding the investment money for real estate.
Yeah, and another area that's emerging right now is the same thing through life insurance. You get a life insurance plan on yourself, you pay into it, and then you borrow against it. And there's a lot of financial planners putting people in those kinds of products. There's a ton of stuff out there, even if people don't have the savings, that they've been building up these nest eggs through 401ks or through life insurance plans or whatever. And they do have control over that. They don't know what to do with it.
Yeah, so there are more money sources, again, ones that you already have, not that you have to save yourself and wait for all the time. Well, Ken, any last thoughts about finding the investment money for real estate?
It's everywhere. And I really mean that. There's not a day that goes by we don't read something about a stock market bust. And I was actually playing golf over the weekend, and I was talking to a friend of mine who's right in the middle of all this. He does IPOs, and he's pulling a lot of his clients out of their positions into cash. For whatever reason, I didn't get into the details, but the point is a lot of people are concerned about the longevity of the stock market, as an example. And I'm not saying it's going to go up. I'm not saying it's going to go down. The point is that there's a lot of people pulling back right now, and they're sitting in cash, and they're wondering what to do. And I'm telling you guys, they're looking for guys like you. They're looking for deals. They're looking for solid people that are finding deals. That's the way all the big money works. I've gone to Goldman Sachs. I've gone to Blackstone. I've gone to Lehman Brothers back in the day. And all that managed money, they're looking for guys like me, boots on the ground, putting it to work for them. That's how the system works. So if people understood that, there's a lot of cash up there that you can't see that is looking for a home in a good investment. And just people pulling out of the stock market is one example.
Yes, there are a lot of instances of found money out there. You just have to find out what avenue is best for you. Well, Ken, you've been really an inspiration to a generation of real estate investors, especially with all of your Rich Dad Advisor books and ones that you've written outside of the Rich Dad Advisor series. You have videos, and a lot of people learn from you that way. What's the best way for Get Rich Education Nation to contact you today?
Keith, thank you. So the best way to reach me is kenmcelroy.com/Get Rich Education. As you know, we've put up a video for just your audience, a 2021 real estate predictions video and show notes. so that they can kind of learn for themselves and kind of take a look at some of the things that we're trying to put out there to help people make good decisions.
That's kenmcelroy.com/getricheducation. Ken, you've been of such value to our audience over the years. Thanks so much for coming back onto the show.
My pleasure, Keith, as always.
Yeah, great stuff from Ken as usual. To attract money for bigger deals, show investors how you're going to add value, say to a big apartment building. And to riff off of the example that he gave, if you have a 200-unit apartment building and you add washers and dryers to them, which gives you only a $50 monthly rent increase per unit, well, if you spread that over 200 units, that's now your rent increase of $10,000 per month. Multiply that $10K per month by 12 to get your annual net operating income. That answer is $120K, and your additional $120K NOI divided by your prevailing cap rate in that area, say it's 8%. There you go. That gives you a $1.5 million valuation increase. That's how you attract investors. It's showing them that right there. When it comes to qualifying to buy more property, it's keeping in mind, what are you interested in versus what is your lender interested in? That's a great reminder that Ken brought up there. 1 to 4 unit property values, they are based on comparables, and the lender looks at you and your own personal credit profile in you qualifying for those properties. And conversely, 5+ unit property values, they're based on how much income they generate, and the lender looks primarily at the building's risk profile more than they do at you as an individual borrower. But even for larger buildings, the lender often will look at your credit profile to make sure that you are not a threat to the building. And if you think about it, that makes sense, because a person working for a typical wage at their W-2 job, well, their income level probably is not going to have much effect on the ballast that they can offer on a giant loan amount for, say, a $5 million apartment building. That building needs to have a debt coverage ratio from the rent, so that debt can be serviced that way. Hey, learn more from Ken. He's got the housing predictions video for you and a lot of good material there at kenmcelroy.com/getricheducation. Next week, as always, I'll be back here to help you build your wealth. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.